We cover support and resistance. We cover key levels, volume, simple moving averages, Fibonacci levels. We cover price action. That's just the way price moves. And the last part of our charting Zoom is the importance of trend lines. So we're at the home stretch, guys. Ninth inning. Or should I say eighth? Or should I say seventh? This is a 7th inning stretch, right? Right, Lou?
Yeah, exactly, man.
2 outs. I'm on the plane, losing second.
Okay, so trend lines. So what are trend lines? So what we're gonna draw is support and resistance with trend lines. We're gonna search for overall structures and see what we can find. So let's start off with support over here, right? We're gonna do our drawing tools. We're gonna do the trend line tool, and we're gonna mark support, which is the floor, right? Support and resistance. Boom. See that? So we got resistance over here. It breaks out right here. Then it comes back down to the structure. And we do this to identify any structure. So anytime you see a structure being broken, you'll generally see a big move after that. So we're going to use Tesla to note this. So look at all these drawings. Craziness, right? So look at this. We're going to go back in time. Okay. So what day is this? This is, we're going to go to July 13th, right? So July 13th, all I did here, all those triangles you see, I drew resistance, I drew support. Once it breaks out the structure, you'll see a big impulse. And that's what we see here. Broke out of the structure and it went up on an impulse and it bounced off here. So what I did, I made a trend line from this top to that top for purple, right? All I'm doing is support and resistance. So we're gonna remove everything just so you guys can see how I did.
I remember this trade. You told me about this one.
Yeah, one of the people in the chat room, Bertrand, he's the one that got me into trading. He one day I was working and he showed me a Tesla option contract where he made $5,000 in a day. And I was like, holy smokes. That was in November or something like that. I got into trading. No, that was like January. I got into trading March 16th was my first trade. I made $1,000 off a JNUG call option. I was sick with Corona, and we're gonna look at JNUG real quick because I made that trade prior to me knowing how to chart. But all I knew was okay. We're in Corona. The economy's going down, and JNUG is a gold mining ETF. That's what I know. So I did okay. Okay, call option. $1,000. Oh, I made $1,000 my first day. It changed my life forever. So
Rico, coño.
March 16th. Look at this. I must have done it in opening. Wow, I caught the bottom. Unbelievable. Yeah, I caught the bottom, and this is called a dead cat bounce. So a dead cat bounce is when it drops off a cliff and bounces off the floor, comes back down. Dead cat bounce. So I think that's pretty much, knowing what I know now, that's a lot of shorts covering right there. That's all that was. And that was $1,000 in a day, gentlemen. So I had no idea what the hell I was doing, by the way. Anyway, back to Tesla. So you want to draw a structure. Draw a trend line, drawing resistance. And how we draw that is the top of this wick touching the top of this candle over here. And it'll look something like this. We want to extend that. Boom. That's what that looks like. Broke out the structure. You have a big impulse. It stopped right there. And what happened here? There's another level of structure here. So what do? We draw with the trend line. Support. We draw resistance. So over here, I didn't draw. The reason why I didn't draw it right here in the top of the wick is because the first and second point are touching. So what's gonna look like if I do it like this, then you won't touch the second point. This is a wick. It's not even that strong. The wicks aren't that strong. So draw it from the body. Sometimes you will draw it like from the wick, but these first 2 points are strongest. So that's what you gotta do. You gotta draw from this body, touching that body. Boom, that's what it's gonna look like. And if you notice, so this is called a bull flag. So there's 3 parts to a bull flag. There's an impulse, there's consolidation, and what consolidation is when the trading range goes from wide to narrow. That's why you get that triangle. So that's the second part. So this is that's the flagpole, and this is the flag. So bull flag, impulse, consolidation, and the third part you want to watch for the breakout. So over here, they announce these people at Tesla are smart because this is the tip of the structure. At the tip of the structure, the stock has to make a decision whether to go up or down. So at the tip of the structure, they announce they're going to be included in the S&P 500. And the reason why that's important is because if you're included in the S&P 500, that means major institutions could drop millions of dollars on your stock. And what happened after it broke out of the structure? It went on a crazy, crazy run. Look at this. So bull flag, impulse, consolidation, breakout. And then it just went crazy. You can see the same thing happen in the price structure over here. You have an impulse, consolidation, breakout. Impulse, consolidation, breakout. And then all these lines are just me, like I was just playing it. So that's what all those lines are. So this is why trend lines are important. You want to mark key structures. And look at this over here. If you extend the trend line, let's say, okay, I'm gonna draw from here to there, right? I'm gonna change the color so you guys can see it better. Let's go with purple. I like purple. Purple. Let's extend it. We could either extend to the left. This is why I like Thinkorswim. They have excellent charting technology. Or extend to the right. Right? So if we take these 2 points and extend them, look how the stock responds to it. It uses it as resistance here. So it breaks out the structure. Let me remove all of this stuff so you guys can see it better. So just off me extending this trend line 2 points, look how the stock uses it as resistance here. Breaks out a little bit here, but then it has difficulty going up. That's the importance of trend lines. The stock will respond to trend lines if you draw it properly. Let's make a big observation here. So this is Zillow. In Zillow, I actually called this the morning of. You see these icons here?
Mm-hmm.
This means that they reported their earnings that day. So every quarter, a company has to report their earnings. And whether it's good or bad, you got to get a reaction off that. So Zillow reported good earnings this particular day. They reported good earnings and the stock gapped up. So that means the movement either happened after hours or pre-market. That's when the companies can report their earnings. They can't report their earnings during open market hours. So it's either pre-market or after hours. They had a good earnings report. It gapped up, consolidated. And what do we have here? We have a bull flag. Okay. So we're going to go back in time to 12/9, which is the day it broke out. And we're gonna see why did I call this out in the chat. I called it out in the chat at 9:25. I'm like, yo, keep an eye on Zillow. And that particular day off options, you were able to make 800% in one day off a safe play. And we're gonna talk about why it was safe. So let's go back in time to 12/9. This is gonna be the last part of the Zoom session. So we'll go to 12/9. So look at that. This is opening bell. We're going to pause it here. So look at this. So I drew the resistance trend line. I drew the support trend line. And on the daily, it's setting up above. It's breaking out the structure. It's using the resistance as support now. Remember, old resistance becomes new support. Right? So we're going to change time frames to the minute chart. Look what happens. We have like the perfect storm here. And I'll tell you why it's the perfect storm. We have so many buy signals. So first, we're going to mark the pre-market high. If it breaks the pre-market high, it's a buy signal, right? So first of all, look at the amount of volume we have in comparison to the average volume. The average volume is all the way down here. Look at the volume for the day. That's already one thing going in our favor if you want to go long. Look at the 20 in comparison to the 200. The 20 is on top of the 200 and it's opening up. Opening up. We got the narrow angle. We see the narrow angle here, and then we see like an upward slope of the 20. That's exactly what we want to see. And so we see massive volume. We see the price setting up above the 20 SMA, right? So we're going to play and see what happens. So we're going to fast forward a little bit. So we got massive volume. It breaks pre-market high, but then comes back down. And if we look at the daily chart, we see, you always want to switch time frames, see what's going on. So on the daily chart, it's setting up above the structure that we made, right? And all we did a trend line from this top wick to that top wick, right? And we marked that yellow line, we marked the pre-market high. What you can see on one time frame, you'll see on all the others. Look at this. Massive volume, the 20 is above the 200. It's also above the VWAP as well. So right here, we get like a little fake out. It comes back down and retraces. So we're gonna fast forward a little bit. Actually, no, let's see what happens here. So broke the pre-market high, and now the pre-market high is like support now. Look how this wick hit right there. And when you're in a trade, you also want to learn time and sales and level 2. So this is very important because it tells you all the orders coming in. This you have to spend some time and learn on your own. However, all you want to see is you want to organize it by bid, price, and the ask. So you want to see the bids. You want to see if the price holds. So we have 1662. Now you see red 1625. You see green 1624. See 1618. So you want to get good at learning how to spot this, how to spot the orders coming in.
That's just buying and selling, right? People buying and
Yes,
selling.
correct,
Okay.
correct. And over here, level 2 is the same thing. The bid is the buyers, the ask is the sellers. So you never want to see, like, this is the amount of shares per order. So one thing you don't want to see if you're long, you don't want to see like a massive number here, like 5,000, because somebody's selling 5,000 shares for whatever price. That's called a wall. You generally want to see like no walls here, and you generally want to see like a massive demand. You want to see a lot of bidders and not that many askers. Like if you're long, of course. So what do we have here? Breaks the pre-market high, comes back down, uses the 20 as support. We're gonna extend this this pre-market high that we drew. We're gonna extend it, see what happens. Look, now is below that, so it's resistance. So again, paying attention to time and sales and level 2. And watching price action. So now you get to see a big increase in volume. It broke out, pre-market high. And we're just watching. Okay. Now, if you look at, now options is a whole like course in itself. But what I can tell you is that options, they have 3 components to them. They have an expiration date. It always expires on a Friday. So that's where you see all these dates here. So December 11th, 2020, all the way to January 20th, 2023. So we're going to go to December 11th, 2020. Generally, the closer the expiration date, the cheaper it is. And the reason why it's cheap is because you have to be right by that time. Otherwise, your option is expired worthless. So there's a time decay element. So this expires, well, this particular day is December 9th. These options expire Friday, December 11th. So there's 3 components. There's a expiration date. There's a strike price, aka your target price, and there is the price you pay per contract. So right here, the bid and ask, that's exactly what we went over before. The bidders are the buyers, ask is the sellers. So what you want to see in an option contract, you want to see open interest means how many contracts there are open. So we have, in this particular case, for the December 11th contract, strike price 118, we have 160 contracts open. What you want to see is open interest above 2,000. That means there's a lot of people with that option open. And the reason why you want to see that, you generally want to see high open interest and a small spread. So a spread is the difference between the bid and the ask. And why do you want to see that? Is because the smaller the spread, the more liquid your asset is. So that means the faster you can convert it to cash. So look at something like Apple. Well, first, let's look at the spread between for Zillow, right? So we see the bid is 117. Well, that's like a small spread, but look at something like Apple. Apple is always like 1 cent away from each other, the spread, right? Meanwhile, let's see like some penny stock. Oh, we didn't have let me see. They don't got my pennies up. But anyway, so Apple, you always see the spread like 1 cent away from each other. And look at the open interest for contracts on Apple. So you have
Whoa.
very high liquidity here. So look at the difference between the bid and the ask here. So the bid is 145, the ask is 147. So you're gonna be able to sell those contracts ASAP and for what they're worth as well. So you want to see small spread, you want to see high open interest, and the implied volatility, Jesus. So you want to see this below 80%. Anything above 80% and you're being overcharged. But implied volatility, the more volatile it is, the more changes there are in a short amount of time to that price, the higher you'll see this. I've seen like GameStop was like 900%. I've seen.
Whoa.
You know what I'm saying? And so look at in comparison to this, like it's 26%. So these contracts are cheap. But let's go back to Zillow and like why it was a great play. So so options, you want to see a high open interest, you want to see a low implied volatility. Generally anything over 80% you're being overcharged. The higher the implied volatility is, the more expensive the options are. And you want to see a small spread between the bid and the ask for high liquidity. And these so these are call options. So this is like going long, and put options are going short. The put option over here. So you have your strike price, aka the target price. You have to reach this target price, this strike price, by December 11th. Otherwise, your contracts are worthless. But you don't have to wait until the expiration date. You can sell contracts just like you could sell stocks. You could be in and out in seconds, or you could wait that time and see what it is. Everything is according to the chart. Is the chart good? Do you have volume? Do you have all those factors that we spoke about, right? So let's go back to the chart. Let's see what happened. Look at Zillow doing its thing. Crazy. Look at that. And we're going to look at the daily chart, see what's happening. Look at that. So you got that big green candle set up right above the resistance trend line. It's using it as support. And what's going on with the SMAs? The same thing we spoke about. Every single run you'll see in your life, you'll see the SMA 20 opening up from the 200. The angle between them will go from narrow to wide, and the stock will always ride the 20. Look, it goes up, comes back down, uses the 20 as support, bounces up, comes back down, and remember, it'll always use the 20 as a rubber band. It'll always come back to it. So let's fast forward time and see what happens. Let's go to 11:30 a.m. Boom, 123. And again, if we notice, this is the minute chart. So every candlestick is a minute. Comes down, breaks the 20 as support. And where does it find support next? The VWAP. That's why VWAP is important. Bounces up from the VWAP, goes up, comes back down, breaks the 20, uses the 50 as support, comes back up, and rides the 20 all the way to 124, if I'm not mistaken. Let's go to 12:30. I think 12 o'clock was the end of the run. Yep. So it goes, yeah, exactly at 12. 11:54 was the high of the day, 124.64. And let's look at what that looks like on the daily chart. Look at that. Beautiful. Beautiful. Textbook. This is a textbook breakout. And let's see how the options are doing. First of all, let's go back in time and see what the option contract was at 11:53. Now let's do 52. Look at that huge candle. Look at that. Let's go to the options. Look at that. 800% on 124, 950% on 125. We'll multiply your money damn near 10 times
God damn.
in one day off a safe play. This is a safe play. Why? Because we followed all our rules. We took note of the structure by drawing trend lines. It's set up on top of the structure that we drew, right? We go to the minute chart. It sets up, first candle sets up right above the structure, the purple line. It broke the pre-market high. There's so many buy signals. Let's check the 10-minute chart. See the overall trend for the day. Look at the overall trend for the day. We got massive volume. The 20 sets up above the 200, opens up wide. This is textbook execution. Right? And you can always utilize different time frames, 5-minute. Because sometimes the minute chart will fake you out. Like over here, maybe over here you could have got faked out, right? Because it broke the 20. But guess what? If you let it rock a little bit, it bounces back up from the VWAP, right? And yeah, you utilize different time frames, see what's going on. This is the hourly chart. Look at that, beautiful. How about the 4-hour chart? Look at that. Look at that. You know what I mean? You could also do this. See how it found like it had a difficult time passing that? It zigzags over here, and then it found support on that line. Boom, it broke out. Unbelievable. 800% one day.
Wow, that's crazy.
Hey, can you go back to those options real quick, Junior?
Sure. Ask me anything you want.
So on that particular contract, right? The strike price is 124.
Yes.
So how do they calculate the change in to make it go up to 970? That's what I've been trying to do the math in my head.
Okay, so basically this bid price went up 800, whatever percentage it is. So that the percentage it calculates is what was this option contract worth in the beginning of the trading session. So this option contract was worth fucking 8.4 times less than what it is now.
Okay, so that's the value of the contract. So that's what the calculation on the percentage will change.
Yes.
Okay, that makes sense. So let's say the contract was 1,000. Now the contract is worth 8,000.
Yeah, basically.
Gotcha.
So this is actually the change between the price it was yesterday.
See, that's what I was missing.
Yeah. So it was from yesterday, the price of this option contract went up 844%, or it went up 8.4 times. Okay.
There you go. Nice.
So again, you want to see open interest high, you want to see implied volatility below 80%, and you want to see a small difference between the bid and the ask. You want to see a small spread so you can sell your options quick for what they're worth. Okay, so yeah, this is let's see what happens on the following day to end our charting session here. So you guys are having more understanding?
Hell yeah.
Yeah,
I
for
love
sure.
it. I love it. I love it. So I'm gonna actually make. Look at this nigga smiling. This nigga sees the money already.
This
So,
is life changing shit, bro.
well, I'm glad I could do that for you.
Absolutely.
So we're gonna fast forward and see what happens on the subsequent days, and we're gonna see why trend lines are important. Okay, so let's go to the past 5 days. So I fast forward. That day was Wednesday. I fast forward all the way to Friday, and we're gonna see why trend lines are important. So if we go to the daily chart, let's go to our overall structure, right? So on that day that it broke out, it went all the way to 124, and then it came back down. And then what happened the following day? It sets up right on top of our structure. It retraced it. It tested again. Set up right. So yo, you could have played this like a fiddle, and you would have been up like 50 bands in 2 days, understanding these concepts. At the time, I was still testing it out, so I didn't capitalize that big on it. But it's I learned some life-changing moments those days. So we're gonna go to the 5-minute chart, 5 day. This was the day that it broke out. This was the day that we went over. So this was Wednesday, December 9th. Again, went all the way to 124. And then the market tanked that day. I remember the market tanked that day. So that made this play go back to where it was. But guess what? You could have done puts. You could have done puts right here and capitalized off the movement downward. So this is a game, gentlemen. This is a game that I know you guys can get very good at. So look how it came back down to retrace that level that we drew on the daily. So here the market tanked, SPY and QQQ tanked, so it drove everything down with it. Came back down, boom. Look at the following day. It set up right above our trend line, just like it did this day. The only difference is the price is underneath the 20. It didn't set up right above the 20, but guess what? It bounced up with so much volume. Look at the volume. You get increasing volume as the stock goes up. So it ended up setting up above the 20 anyway and doing the same pattern it did before. Set up above our trend line, goes up on massive volume, and follows the 20 all the time. Goes all the way up, and then you see it kind of goes horizontal a little bit here and breaks the 20, and again follows the resistance and support of the SMAs. Goes all the way up, and then it consolidates a little bit using the VWAP as support. Boom, goes up again. And that's how price moves, man. Price moves depending on levels and simple moving average and volume. Always draw your trend lines to notice any key levels of structure like we have here. Broke out of the structure, went all the way up, came back down, retraced, used this level as support again, and went up. And that concludes our charting session. How was that, gentlemen?
I agree with Robin. You should probably do a free webinar for this stuff.
Thank you. I appreciate it.
Yeah, no, I'm serious though.
That's great, bro.
It sure is.
A lot of info.
So,
Okay, go
yeah,
ahead.
what's up? No, talk to me.
I
No,
need
no, I
to
was
steal
just
this guy for a couple of days.
the contracts always like when it comes to like shorting and buying, contracts. That's usually what always used to trip me up
Mm-hmm.
because I'm used to like the the traditional, you buy a stock, you hold on to it for a while, and you sell it when it's high. You know what I mean?
Yeah,
Like
buy
all
low,
these
sell
other,
high.
yeah, all these other options. Like when I on the chat, I was like, I was trying to keep up with you guys. I was like, yo, what the fuck is this contract shit? I don't even know this bullshit.
So I mean, so one contract is in control of 100 shares.
It's like
That's-
leverage.
Yeah, so that's why you see all these crazy like percentage increases, because you're basing it, because one contract is in control of 100 shares. So if your price, if your stock goes up $1, you didn't make $1, you made 100.
Mhm.
You know what I'm saying? That's not exactly how the math works out, but that's the basic overall gist of it. You're in control of 100 shares, so you see a lot more percentage increase.
Exactly, and then your risk is a lot lower because you don't actually own the stock, but you can buy the stock or you can execute the contract before the expiration if it's not worthless, of course.
Yes, yes. I mean, that could be debatable as far as like your risk, because remember, there is a time decay element. So if the stock doesn't move, you're still losing money, because it's like the window of opportunity for profit decreases with time. And
It's like a 50-50.
So
yeah,
you can only lose your contract, right? So you only losing the money you spent up front.
exactly. You only
Well,
losing the money
So
you
that's the
spend up front.
leverage. Versus like stocks, you can lose everything if you put your money in the stock.
yes,
Nah, I mean, here's the
exactly.
thing though. Here's the thing though. Your contract could expire worthless, so you can lose everything that you have invested in those contracts. You know
Yeah,
what I'm
yeah,
saying? So,
yeah. Got
um, I always tell people, stay away from contracts until you learn how to trade. Because once you learn how to trade, then you can start messing with contracts. Because what I did today with Tilray, I did a contract off the bounce that they did. Like I was only expecting to scalp it. So what scalping means is you're in the trade for seconds to minutes. Swing trading means you're in the trade for more than one day, and a day trade is buying and selling the same day. It could take hours or whatever. So I was only expecting to scalp it. Now with all the momentum, I'm still in the play. Um, but for again for Tilray, I'm looking to sell tomorrow at open because it's super overextended from the 20 on the daily.
Yeah, but that's what I mean though. Like you can only lose what you paid in the contract. Now, obviously, if you put all your money in your brokerage account in contracts and then they're all worthless, then you're screwed.
Yes, a lot of
yeah.
people blow up their accounts using options, which is why I always say, yo, stick with shares, because with shares, the movement isn't so drastic. Like you could be down 20% in seconds on an option contract. Shoot, there's been option contracts I'm down like 70% in like in a short amount of time. But they move so fast, you don't have enough time to react. So
The
that's what
minute
I'm
you get in, you down already.
right. There's some instances that
Happened
happen
to
that
me.
way. Yeah, of course, to everybody. But with shares is more controllable, because guess what? You could set a stop loss. Stop losses are very important. I always
Mhm.
recommend people
Yeah.
use a stop loss, and so any more questions regarding anything? You guys need any more clarification with anything?
Nah, I think you nailed it in the spot, man.
I want to show you one last thing on FinViz before we go, and it's to drive home the point that patterns happen all the time.